Hello everyone. I'm going to present you a research project about investments in cryptocurrencies, which is done by Zhuka Dulei and me, Wang Jiancheng. At the beginning, let's take a close look at the recent cryptocurrency market. At the start of last year, 2020, the market capitalization of cryptocurrencies was approximately $191 billion. By the end of the last year, 2020, the market capitalization of cryptocurrencies was approximately $760 billion. During only 1 year, the cryptocurrency market experienced an increase of nearly 400%. Moreover, there are many reasons why investing in cryptocurrencies is more beneficial than investing in stocks. I will share some major reasons here. The first one is 24/7 access to investment. Unlike trading stocks, the cryptocurrency market is not strictly regulated. Setting up a trading account is relatively easy, and there is no need for a broker. Moreover, it's accessible 24/7 across a growing number of exchanges. The second one is low transaction fees. Trading on cryptocurrency exchanges incurs fewer costs. The costs associated with transacting on the blockchain are minuscule, only consisting of any mining fees. The third one is global access. Stocks are usually traded in the country where they are registered. However, cryptocurrencies, led by Bitcoin, are accepted globally. Moreover, the cryptocurrency market is more transparent. The transaction would be clean, swift, transparent, and irreversible. Lastly, cryptocurrency cannot only be treated as asset. Cryptocurrencies can also be used as payments for goods and services. Despite the potential of high returns, investors are still skeptical about investing into the cryptocurrency market due to the high volatility. Here are several cases that cryptocurrency prices change dramatically within only a few seconds. Situations just like Nano and ZKS shown here are very common in the cryptocurrency market. Such being the case, most investors couldn't tell when and where these cryptocurrency disasters would happen again. As you can see, these empirical findings, such as extreme volatility, bubble behavior, and inefficiency in the price discovery process of individual cryptocurrency, give rise to the need of diversified cryptocurrency investments as a means of mitigating risk exposure in the cryptocurrency markets. In this regard, we can proudly say that our research project has offered and compared some well-behaved cryptocurrency investment strategies. The first model is Markowitz model. It was the first that defined the concepts of risk and risk management related to the financial investment management. It is the optimization approach to investment in this project. Next method is Pharma-French three-factor model. This model is an extension of capital asset pricing model, which aims to explain the average stock returns through three factors, and it is the sorting approach to investment in this project. The third model is long-short-term memory model, and this model was chosen because it is able to solve the complicated issues that have never been solved by previous time series algorithms for prediction of univariate data. It is a prediction approach to investment in this project. So in this project, two classical portfolio techniques and one modern portfolio technique were implemented in order to test the performances of portfolio strategies. This project adopted analytical criteria including Sharpe ratio, Kalman ratio, and tail ratio, most of which have become the most widely used methods for risk-adjusted return calculation and portfolio analysis. Then I will talk about how these three strategies work and their backtesting results. For Markowitz model, To obtain the optimal portfolio, an optimization problem is to be solved. This project mainly focuses on two optimization methods to solve the optimization problem. To solve the optimal portfolio which considers the short selling constraint, the closed form was applied. And to solve the optimal portfolio which doesn't consider the short selling, quadratic programming was used. Moreover, the 1/n model was also used to assign each cryptocurrency with equal weight, which may be considered as a benchmark. And now let's take a look at the results. The table shown on the screen displays the result of each portfolio by the end of the year 2020. Unfortunately, only one strategy under Markowitz model performed better than the market, which is this one, liquid long and short strategies. For farmer-friendly three-factor model, it aims to explain the average returns through three factors. The first factor, market risk, is the excess rate of return of the portfolio over the risk-free rate. The second factor is the size factor, which is the outperformance of small capitalization companies relative to large capitalization companies. And the third factor is the value factor, which is the outperformance of high book-to-market companies versus to low book-to-market companies. However, since cryptocurrencies do not have book-to-market ratio, as they are different from stocks, thus, a new factor is needed to evaluate the value of a cryptocurrency. A good measure is network value to transaction ratio, NVT. The NVT ratio is defined as the ratio of market capitalization to transaction volume of a cryptocurrency. The first table here shows the results of the portfolio sorted using market capitalization (SMB). And the second table shows the results of portfolios sorted using NVT. And the assumption of Farmer and French apply also to the cryptocurrency market, because it can be observed from the table. The small capitalization portfolio SMB1 here, and the high value portfolio as NVT5 outperform the market, while the large capitalization portfolio SMB5 and low value portfolio NVT1 underperformed relative to the market returns. For the last strategy, recurrent neural networks with an LSTM architecture have more complex units that maintain an internal state and contain gates to keep track of dependencies between elements of the input sequence and regulate the cell's state accordingly. A common LSTM unit is composed of a cell, an input gate, an output gate, and a forget gate. These three gates recurrently connected to each other, aiming to address the problem of vanishing or exploding gradients by letting gradients pass through unchanged. As for the specific settings of our LSTM model, is that we only include 10 hidden units, and the mean-squared error method is used as our loss function, and we choose RMS-prop as our optimizer. As shown here, the capital of the strategy with long and only positions steadily increased from January to August, and then went into a vibration phase at the beginning of September up to the November, and then rocketed up suddenly in December here. Moreover, although the market suffered a huge decrease with a daily return of almost negative 30% in March 2020, as you can see from the orange line here, our LSTM strategy were able to prevent such loss effectively, since they successfully predicted a bad market and then entered into an empty position with no cryptocurrency held. The blue line at this point is equal to 0, which is the actual strategy return at this point. Our LSTM strategy finally achieves an annualized return of almost 2000% compared to the market return, and we have a smaller max drawdown compared to the max drawdown of the market. So that's our presentation, and this is our whole research project. Thank you.